But I think the macro has entirely changed. That's what I've been trying to educate people on, is the macro we all grew up with doesn't exist. It's now into another phase. And I think we had the Great Reset in 2008, while many people still expect a Great Reset. If I think of a Great Reset in 2008, they basically said nobody has to pay interest.
Mm-hmm.
And the government's never going to pay interest again because we're just going to debase the balance sheet. Okay, that is a reset. It's basically a debt jubilee without cancelling the debt. And this rate cycle was driven by two things: the pandemic reopening, not enough supply around, so supply chains, and the extra demand of people coming in, much like straight after World War II, we saw very similar. And some of the direct stimulus payments, because that obviously goes straight into direct spending, but that usually comes back out over a year. That is mainly the driver of this inflation. And all of that is coming out. Now, Russia was the accelerant that took inflation higher than it, the Ukraine crisis higher than it would have been. So maybe it would have peaked out at 6%, which would have been still a high, tough cycle, but we got the extra 3% because of what happened. I think all of that gets unwound. If we look at the Trueflation forecast, it's already at current inflation is currently like 2.1% in the US. My work suggests that we probably hit zero or go negative within the next few months. So that's a complete unwind of the inflation spike. Now, the dirty truth is, as we all know, prices never come down.
No,
commodity prices can, but for you and I, prices never come down. And that's just made people that bit poorer again because wages never went up as much. Now, people argue that wage growth is going to continue to rise, but not in an inflationary environment and not with AI. It's just not going to happen. So there is this pulse of wage increases to stop people getting ridiculously poorer. They're much poorer in real terms already, but you can't keep driving it higher because it's just not going to work. I own very little Bitcoin. I'm actually more bullish on ETH, but it's the same thing, right? We're talking about capital going into the space. Yeah, you've got the perfect setup. We had a massive bear market. It hit that long-term trend, 2 standard deviations oversold, triggered all the kind of technical signals you want. Right when my forward-looking indicators suggest the economy starts picking up over time, but debasement is going to increase. It's like it's the perfect signal. And now you've got the institutions to come into the space and regulatory clarity in the UK, Europe, Switzerland, Australia, Hong Kong, Singapore, and the US will get it at some point in the cycle. And then the Bitcoin ETF. It's like, okay, this is it. Game on. So ETH is really interesting. And the reason being is because the more activity, the more ETH gets burnt. So supply keeps going down. They've now got staking. So that's removing stuff out of the market. So in a bull market, there's going to be less and less ETH. Most people are going to stake it in some way, shape, or form. So the liquidity of ETH on the upside is going to evaporate. My guess is the skew in ETH call options out a year or so doesn't take this into account. People are sophisticated. There's great ways of funding ETH calls with selling Bitcoin calls. So you're trading the vol spread and the price spread. You can do it delta neutral or not. I mean, there's a lot. I just have a feeling that the market is not pricing this correctly. I was speaking to some of the big kind of crypto traders at places, some of the big hedge funds, explaining this thesis. They're like, yeah, this is probably not priced because normally it has been for a while, relatively flat going out for a year. People don't know how to price long-term vols. So anyway, it's just, there's an interesting thing there.